XDTE, the crash showed us these funds' true colors. This article was written by John Bowman. Summary: I'm bullish on derivatives ETFs, especially as actively managed covered call strategies gain popularity. NEOS S&P 500 High Income ETF SPYI and Roundhill S&P 500 DTE Covered Call Strategy ETF XDTE are two of my top picks. These ETFs offer unique approaches to generating income from the S&P 500, appealing to different investor preferences. This article discusses the key differences between these funds in their construction, advantages over each other, and yields. I am John Jack Bowman, a former economics teacher turned investment advisor. I'm a contributing analyst at the investing group Sun Garden YARP portfolio. Introduction: I've been fairly bullish on the future of derivatives ETFs, especially in the last few years, as more actively managed covered call strategies have hit the market and changed the game as we know it. Two of my favorites, for different reasons, have been the NEOS S&P 500 High Income ETF, SPYI, and Roundhill S&P 500 Zero DTE Covered Call Strategy ETF, BATS XDTE. I've covered both funds in the past on their own and given buy ratings to both funds. Most recently, I covered XDE as a way to weather the storm, which I posted around the market bottom in April. My last SPYI exclusive coverage was back in December, but I've compared it to other funds more recently, like SPYI back in late March. At the time when I wrote the Weather the Storm line in April, I had no idea that we would bounce back so quickly. Spurred on by a turnabout in the tariff policy that brought the markets down in the first place. Very recently, I learned that this flip-flop behavior and its whipsaw effects on the market is being called the taco trade. How did they handle the big swings? The question for both SPYI and XDTE as S&P 500 covered call ETFs isn't how they would handle the downturn, but how they would handle the recovery. It's common for covered call funds to outperform the index, even if just slightly on the way down, since the income from the covered call component pads the downside, again, just slightly. From February 19th, the last market top, to April 8th at the market bottom, we saw this in action. Both funds incur essentially all the downside of the S&P 500, but the income they generate is distributed in cash, so it helps buoy the return of the funds. While it's nicer to draw down 16% instead of 18%, it's still not very nice. Keep this in mind when investing in these kinds of funds. What should concern investors is not the downside, since that is a known equation. You lose basically what the index loses, but how much upside these funds participate in on the way back up if and when that happens. The nature of covered call funds means that their upside is capped, and if you incur all the downside but little of the upside, you fall behind quickly. One of the oldest covered call funds, QYLD, which I've called old and out of style, falls into this trap, where its upside has never been enough to make up for the downside it incurs. Subsequently, over its lifetime, it has lagged its index something fierce. Year to date, we can see that while its reference index, the NASDAQ 100, recovered from those April lows and is now back toward being even for the year, QYLD never recovered all the way. Its upside was capped, and once that cap was breached by the market, QYLD stopped gaining much in value. So, what about SPYI and XDTE? Thankfully, we have QYLD's sister fund, XYLD, to compare to on this front, to see the worst case for a covered call fund. Please don't attack me in the comments for that last use of air quotes, YLD investors, but please do take a long look at this next chart. Here are the same funds, SPYI and XDTE, plus XYLD, from where the first chart ends, right at the very bottom. This is a consequence of the capped gains of each fund and the style of options management they use. XYLD is a passive index that rolls at a certain point in time every month. See when XYLD hits its upper cap? Over time, moments like this happen, and the differences in strategy can make or break a given fund. That 10% gain XYLD investors missed out on from the market rebound isn't made back easily. SPYI investors are surely happy their miss was less than 3%. If you invest in covered call funds, these kinds of misses are impossible to avoid. It just comes with the territory. The goal is to do it as little as possible. What's the difference? The key difference between these funds is their options execution strategies. Strategy-wise, both have the same foundation. Buy the S&P 500, SPYI owns long stock just like an S&P 500 index fund. XDTE owns long call options on SPX, which are settled in cash and serve to provide the same exposure as long stock. Sell call options against that position for income using short call options on SPX, which are settled in cash, avoiding early assignment risk and providing tax efficiency. SPYI sell out of the money OTM calls, leaving upside for the whole month. XDTE sells at the money ATM calls, leaving little upside for the day, but resets every day and does not cap its gains overnight. The second part is why their results differ during different market conditions. While both funds use the same short positions, SPX call options, they implement them in different ways. SPYI operates an actively managed strategy aimed at rolling options every month. Although management is able to intervene and manage the options on the fly as needed, this has helped them navigate sudden market shifts, such as the April crash and rebound. XDTE also operates an actively managed strategy, but does not have the onus to intervene between call option sales. This is because, instead of selling them monthly and adjusting sooner if needed, XDTE sells options every day that expire the same day they are sold, 0DTE. Management has to sell a new call each day, meaning they have to evaluate and reposition every day. The daily reset feature of XDTE was one of the ways in which the fund is supposed to outperform other covered call funds, because its upper cap is readjusted at market open each day. And it receives all the overnight gains, losses to the index, which historically is when most of the largest positive moves in the index happen. For reference, XDTE's expense ratio, ER, is 0.97% and SPYI's is 0.68%. But all performance charts shown in this article are net fees. SPYI has a little trick up its sleeve, so it sounds like XDT would be the better fund to consider since it is not always short, long overnight, readjusts constantly, and is more capital efficient than SPYI since it obtains long exposure from call options instead of stock positions. However, SPYI has one major advantage that we saw in action in April and is the reason that it has outperformed over XDT in its lifetime. XDT is the younger fund, and so the furthest back we can take the comparison is its inception. You can see that XDTE has kept up with the market, even outperforming during the 2024 bull run. In a bull market scenario, XDTE is a clear winner, but not all markets are bull markets. In the market's recovery phase in April, SPYI showed its hand and excelled, overtaking XDE's performance. From SPYI's website, the fund utilizes a call option strategy that may include both sold and purchased SPX index options, which may provide the opportunity for upside capture in rising equity markets. I said earlier that SPYI utilizes an index fund-like construction method where it owns long stock. The fund also, tactically, owns long call options in order to offset its upside cap, providing more upside to the fund. This means they are able to manage the short option less, and when its cap is hit, or likely to hit in their view, they are able to charge up the fund with long call options to increase their upside participation. All charts up to this point have been total return, which includes dividends paid but not reinvested. Here are the prices of the funds by themselves. Of course, both of these funds introduce manager risk, or key person risk, where investors are reliant on management to make active decisions day to day. There does come a risk with this strategy, as charging up your upside with long call options may mean more downside if the managers are wrong. Timing is key, and while it seems that SPYI nailed the timing this time around, that doesn't speak for the future. Being reliant on the timing and skill of the managers to make up for deficiencies in the covered call strategy is a risk many investors may not want to take, especially if they consider that the long call option strategy SPYI employs hasn't mattered all too much until recently, during this flash crash. Before then, XDTE was outperforming. Here's a chart of XDTE's inception to the peak in February of this year, just the bull scenario. XDTE was outperforming SPX itself, which was a massive feat and one that rightfully garnered a lot of attention from investors. We know from pulling this chart out to the full lifetime shown earlier, shows XDTE as the worst performing asset of these three. Performance charts are all about timing. Here is the takeaway. If you expect a choppy or down market, SPYI is the better choice. If you expect a secular bull market, XDTE is the better choice. SPYI is unlikely to keep up with the index or with XDTE in pure bull markets because the managers don't tend to employ the long call options regularly, only in circumstances where they feel like the market is about to, or already has, breach their upside cap. They don't hold these options on a typical market day. They are the little trick in the sleeve, and the less they have to employ them, the better. XDTE is unlikely to keep up with the index or with SPYI in choppy or down markets, as its uncapped overnight nature and daily reset behavior works against it. Capping upside on days when the market is violently moving upwards after recovering from flash crashes, SPY versus XDTE dividends and yield. One of the major differences between these funds is their level of distribution. Since XDE writes ATM options, its payouts are larger and more frequent than SPYI. It pays weekly and carries a distribution rate of nearly 32%. In contrast, SPYI pays monthly, and its distribution rate is a little over 12%. We can see how these contribute differently to total return, as SPYI's gap between price and total return is far more narrow than XDT's, which ends up distributing more but also making consistent price losses. This latter behavior is not necessarily a bad thing and occurs in a significant number of derivative-based funds, but investors should note it alongside their risk tolerance. In any case, this is why I tend to prefer only look at total return when comparing these funds. For reference, XDTE's expense ratio, ER, is 0.97% and SPYI's is 0.68%, but all performance charts are shown net fees. The preference between monthly and weekly is all semantics to me, as the end result quarter by quarter is the same. If investors prefer to have the weekly payouts, XDTE is a clear winner, but if it doesn't matter, SPYI seems to offer a more stable payout, bar the dip in April due to the buying of call options and rolling of the short call. But as we saw earlier, that move helped SPYI outperform during that time frame on price returns, even if its dividend was lower. There is some give and take, but it is generally a fairly even pair, whereas XDTE has far more variable and volatile payments. Regarding taxes, this has been a topic of significant discussion as of late. Both of these funds distribute the often preferable return of capital, ROC distribution rate. For more on that, check out this article I recently published on SPYI's sister fund, QQQI, which employs the exact same strategy, but with the NASDAQ 100 instead of the S&P 500. In that article, I discussed the tax situation in depth. The way that QQQI's distributions for taxes are handled applies to both SPY and XDTE, as it is a byproduct of their use of short SPX call options. Conclusion. Ultimately, investor preference between the NEOS S&P 500 High Income ETF, SPYI, and Roundhill S&P 500 Zero DTE Covered Call Strategy ETF, XDT, comes down to a few factors. Their view of the market conditions. SPYI for a sideways or down market, XDTE for a secular bull market. Their preference for income versus return typically has less price loss but a lower yield at 12%. XDTE typically has consistent price loss but a higher yield at 32%. Their preference for income timing. SPYI pays monthly, XDTE pay weekly. For the market conditions, I am still a believer that the choppiness we've seen so far this year isn't over, especially since we are seeing the market still moved by political headlines day to day, which tend to overreact and overcorrect too often. This makes SPYI a better pick from my view, though both funds retain their buy rating from me. I have a preference for total return, not income or price gains. So on that front, I would lean towards SPYI. If an investor needs the increased income and is willing to give up more upside in rebounding markets to get it, they would prefer XDTE. Personally, that last part doesn't matter to me, but that is fairly personal. I know from the comments on my past articles that some of my readers greatly appreciate the flexibility of the weekly payouts. On this front, frequent is usually better, so I'll give XDTE a small win here. Neither fund is a poor choice for income investors looking to benefit from equity premium exposure through options. And both funds are part of a new breed of options-based income funds that have impressed me, and so both keep their buy ratings. However, if an investor is locked between the two choices, I vote SPYI. Thanks for reading. This article was written by John Bowman.